Here are three things that you need to know right now. We're going to move right off of futures and right onto what's going on with yields here, because the U.S. 10-year yield briefly topped 4% yesterday. That was its highest level on an intraday basis since 2010, on a closing basis or settling basis since 2008. It's the latest move in a historically steep rise that has jolted financial markets this year. And take a look here at the Wi-Fi Interactive, just to take another look at that movement that we have seen. I've got a 20-year chart here of that 10-year yield. Now, this smooths out some of the daily movements, guys, but gives you an idea here of the last time that we've seen a movement like this. This morning, that yield is back below 4%, only at 3.87%. Nonetheless, this reflects what's going on, not just with the Federal Reserve here in the U.S., as Fed speak continues to jawbone things higher, but also on what we're seeing in terms of movements around the globe.
Yeah, I tweeted out this morning, guys, the 30-year fixed rate mortgage, 7.6%. I don't want to hear any strategists come on here and say that, oh, we're nearing some form of bottom in the market, because when you see mortgage rates at that level, you see the 10-year climbing towards 4% and tech stocks selling off. It's just an indication that we are just getting now, I think, started on what markets could look like going into the back half of the year.
Yeah, and I mean, to your point about the global part of this too, more macro, we have to think about what's taking place in England as well. The Bank of England, actually just about 15 minutes ago, that they had announced that they're going to cancel their speech on some of their balance sheet reduction. That was planned and due on September 29th, and that to come from Andrew Hauser. It comes at a time where in the region they're also going to be delaying some of their bond sales, and this is as
they're buying bonds. They are buying U.S. Yes. No, they are delaying. They're not selling. Yes. Now they're buying UK government bonds. This is a pretty dramatic action that they're taking.
Exactly, and so with all of what they have laid out and saying, and couldn't have been more direly straight about what is taking place in England and the actions that they have to take to avert any type of catastrophic event, that just goes to show that it is, to your point, more global, not just the U.S. that's making as many policy decisions as they can right now on both balance sheet as well as policy on the rate side. But I think more broadly here in the U.S., you might even see some of the companies that are most closely annexed to England as well also have some type of activity on or volatility on their stock today, too.
Yeah, I just want to linger on the U.K. for a minute, because what the Bank of England said was very dramatic in its statement. They said, were dysfunction in this market to continue or worsen, there would be a material risk to U.K. financial stability. I mean, that is a very dramatic statement, and they're taking dramatic action to deal with that. They said that material risk would lead to an unwarranted tightening of financial conditions and a reduction of the flow of credit to the real economy. The irony here, of course, is that Liz Truss, the new prime minister, just introduced a tax cut package. So it's almost as though you have the Bank of England trying to sort of make up for an action that the government is taking that it thinks is going to put the country's financial stability in jeopardy. So it's a pretty extraordinary situation there, even as we are obviously concerned with our own issues here. But it just shows what banks around the world are grappling with right now.
Yeah, and even outside of that, it just going back to the markets and why just this action really bothers me, especially these closes into that final hour of trading. Defensive sectors of the market are not working. And a good call out by Dennis DeButcher over at 22V Research this morning, noting that sectors like healthcare, utilities, and REITs, really those sectors that you think investors would navigate to in this rocky environment, they're not working. In large part, you look at a REIT because their cost of capital is going up now dramatically. Their profits might be hurt. Utilities, lots of debt on their balance sheet, lots of variable debt. So as these rates go up, even defensive sectors with already slow earnings growth is going to see even slower earnings growth. And even those sectors aren't working. Everything is risk off.
Yeah, this is a 1-month chart of the sectors in the S&P 500. And you see on the bottom right is that real estate sector that you're talking about.